Hey there, welcome back to my channel, it's me the Mind Injector. In this video we've got a hot topic to discuss, and it's all about SOFI technologies. If you're into finance, fintech or just curious about the latest buzz in the market, you're in for a treat. So let's dive right in. SOFI Technologies, a name synonymous with lending and loan refinancing, has had quite the journey. But here's the thing, they were probably banking on the restart of student loan repayments to be a game changer. Back in March, they even sued the federal government, claiming that the pause on student loan repayments was unlawful. Their logic seemed simple. Fewer borrowers would refinance their existing loans if they didn't have a pressing need to make payments. However, their lawsuit didn't pan out as planned, and today, with skyrocketing interest rates, SOFI isn't in the best position to refinance those loans anyway. You see, as borrowing costs go up, private lenders like SOFI have to raise their rates to match. They also need to keep their rates high enough to cover internal expenses like payroll and marketing. SOFI's refinance rates have climbed from 5.24% for a 5-year refinancing period to hefty 9.59% for a 20-year option. To put this in perspective, the highest federal student loan rate today stands at 8.05% for graduate students as a direct plus loan. However, many existing student loans have rates far lower than this, with the average for all borrowers sitting at around 5.8%. And with all those new income-based repayment options reducing interest payments, refinancing with SOFI at these elevated rates doesn't make much sense. So, SOFI's bottom line could be in jeopardy as repayments resume in this economic climate. Now, let's talk about the inverse Cramer effect. You've probably heard of Jim Cramer, the popular CNBC personality known for his insights on stocks. Well, he recently weighed in on SOFI during a segment of Mad Money, saying, "I think, if anything, I'm a buyer, not a seller, SOFI." However, right after Cramer made this statement, something interesting happened. Investors started selling off SOFI shares, and the stock took a hit, dropping more than 5% in afternoon trading. But hold on, let's not jump to conclusions just yet. The reality is, SOFI's recent stock movement isn't solely because of Jim Cramer's recommendation. It's essential to understand that while high-profile investors and analysts can influence stock prices, market dynamics, including economic factors, play a more significant role. And in this case, the market's reaction might be tied to the Federal Reserve's recent meeting and hints of potential interest rate hikes. SOFI has come a long way. It started as a niche fintech player, primarily focused on student loan refinancing. In 2012, it became the first company to offer refinancing for both federal and private student loans, quickly gaining popularity among young professionals and university students. But here's the exciting part. SOFI leveraged its success in student loan refinancing to expand its services. Today, it's a fully loaded online financial services provider, offering a range of products, from loans and credit cards to investing services and even bank accounts. And this transformation hasn't gone unnoticed. SOFI is adding hundreds of thousands of new users quarterly, with a current total of more than 6.2 million members. In the second quarter of 2023 alone, it added a whopping 584,000 members and 847,000 new products. SOFI's growth isn't just about acquiring new members. It's also about upselling and cross-selling its products and services. Revenue shot up by 37% compared to the previous year in the second quarter. Adjusted earnings before interest, taxes, depreciation, and amortization skyrocketed by 278% to $77 million, exceeding expectations, and the management is eyeing GAAP profitability by year-end. But, of course, with growth comes risks. SOFI isn't profitable yet, and it's still relatively young in the industry. It's making impressive strides, but it's not quite there. Currently, it's trading at under 4 times trailing 12-month sales, making it an intriguing investment opportunity. Before we get into the exciting details, let me introduce you to Moomoo Financial. If you open a brokerage account with Moomoo and deposit at least $1 using the link in the description, you'll get a chance to draw a free stock worth up to $2,000. But that's not all. If you make a net deposit of $100 or more, you'll receive not just one, but 5 free stocks worth up to $2,000 each. And if you're really serious about investing, you can deposit $1,000 or more and get a whopping 15 free stocks, bringing your potential earnings to a staggering $30,000. So, sign up now using the link in the description and get those free stocks. Now, let's get back to the video. So, what does the future hold for SOFI? Well, it's no secret that the company's primary focus, student loan refinancing, could face headwinds from higher interest rates. Federal student loans usually have fixed rates set when the loan was issued. So, for SOFI to refinance these loans effectively, they'd need to offer rates lower than what borrowers initially secured. However, with interest rates on the rise, this might not be feasible without taking a hit. Moreover, many borrowers might not see the need to refinance since they are already locked into low rates. And with the imminent restart of student loan payments, SOFI's success in this sector remains uncertain. On a different note, CEO Anthony Noto's strong language when comparing SOFI to its larger rivals signifies the significant differences between them. SOFI has been growing its total deposits, with an increase of $2.7 billion during the second quarter, reaching $12.7 billion by the end of June. In contrast, some larger competitors like Bank of America and Wells Fargo have experienced declines in average deposits by billions of dollars year over year. Even online banks like Capital One Financial have seen their deposit growth reverse recently, reporting a decline of over $6 billion in total deposits during the second quarter. These dynamics highlight the challenges and opportunities ahead for SOFI as it navigates the evolving financial landscape. In conclusion, SOFI Technologies is at an intriguing crossroads. While short-term market reactions and economic uncertainties can impact its stock price, the company's long-term potential is worth considering. As the financial landscape evolves, SOFI's transformation into a comprehensive online financial services provider positions it well to thrive. With consistent user growth, strong financial performance, and a model focused on member engagement, it's clear that SOFI has a bright future. So, should you buy SOFI stock? Well, it's a speculative contrarian bet, and it might not be for everyone. But looking ahead, 6 to 12 months down the road, things could change, and SOFI might just surprise us. As always, the market has its ups and downs, but understanding a company's potential and its journey can help us make informed investment decisions. This is it for this video, guys. Thanks for watching, and please make sure to subscribe, like, and leave a comment down below.